Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Virus Turns. Yes, the virus is turning our lives and world upside down, especially when it comes to housing. We got a lot to talk about today. I'm going to break up videos now into some more sectional things just because I think a lot of topics deserve their own video. So as we go forward, I'm going to be more finite in what I'm doing with respect to commentary, etc. And there's just so much going on. I mean, every day I'm reading more and more and seeing more things and trying to figure out how it's all going to impact us, the market, buying, selling, mortgages, the whole bit. There's a lot of things in flux right now. And basically, there's nothing really that's been decided. So, we don't know what's going to happen. We just, for example, I didn't even look at the case Shiller stuff, the most recent case Shiller that was put out end of the month last week, just because I didn't have time. I've been out working on a couple properties, working on getting one property set up for renting, and we got that done. So now I'll have a little bit more time to at least move forward and do some of the videos and some of the analysis on what's going on in the news. I just want to say shout out to my friend Swan, who helped me the other day, actually yesterday. We dealt with a basically clogged main drain line out from the toilet out. So I do appreciate the help he gave, and he did all the work pretty much, and I just was there to flush a couple toilets. So shout out to Stefan for helping. I do appreciate that. And now we can get back into these videos and life can go on. That's trials and tribulations of owning property or working for people who own property and doing what you got to do when you work in the rental market. Cash flow properties, great deals out there. Okay, by the way, if you're not already a subscriber, please help my channel grow. Click the bottom right there in your video and click the subscribe button. Thank you very much. So basically, I know that there's other videos you guys look out there, and I don't even listen to them because I don't want to, I guess you could say, taint what I'm trying to do here. I read a lot of headlines, whatever, so I'm not really going to talk a lot about, the salacious part of the business right now. But basically what we found is the past couple of weeks, U.S. labor force, roughly 10 million people have filed for unemployment. So you got to, if 10 million people have filed, there's a lot of people who probably haven't filed yet, or maybe they can't file because they're just the way they're set up, you know what I mean? They own their own business. There could be certain things that they're struggling with right now. So when we see that, U.S. labor market is in a free fall, 10 million Americans have filed for unemployment the past 2 weeks. I think the number, that's just who has filed. We know that number is going to be greater than what's reported here of people who aren't earning income or who are out of a job or have their hours cut back, etc. So there is a point where that's 10 million is a huge number, and there's more that's not reported or not able to be reported. So that's going to grow, and that's why economists and analysts really won't be able to get a handle on just how bad this is going to hurt the housing market. When I talk about the domino effect, it really is, hey, you can't pay your mortgage, and therefore you're going to fall down that certain path, or you can't pay your rent, and therefore, the owner of the property, whether it's an apartment, a duplex, a single-family house, a small multi-unit setup, someone is financing that, and that's going to be, a domino trickle-down effect as well too. So it's going to cause a lot of chaos. It's actually too early to figure out how this is going to play out. I certainly have my ideas, and I think I know where things are going to go. We'll talk about that in a subsequent video. But I wanted just to talk about the sheer volume of 10 million people. It was 3.3 the week before and over 6 million the past couple of weeks. That's just reported. There's got to be more people that can't report or don't report or haven't reported yet. Again, loss of income. You have your own job. You're getting your hours cut. You're making 40 hours a week. Now you're 10 hours a week. All these things maybe haven't quite hit the numbers yet, or we can't even track them. So just keep that in mind. If you want to look at this from a state-by-state basis on which ones are getting hit, states with the biggest unemployment increases, I'm sure this is only on a percentage basis, not an actual pay count of people, but Louisiana is number one, followed by North Carolina, Indiana, New Hampshire, Florida, Virginia, Michigan, Kentucky, District of Columbia, and New Mexico. So far, that's sort of what's been calculated. States with the highest, unemployment increases. States with the smallest unemployment increases, if you want to look on the flip side of that, are Idaho, New York, Illinois, Arkansas, Alaska, West Virginia, Wyoming, Wisconsin, Connecticut, and Oregon. So don't know why there's differences there. Could it be how people are employed? Could it be where they're employed? Could it be factors of the employment? Certain states may have more travel tourism, and therefore that's being hurt first as opposed to people with more static W-2 type jobs. So again, I'm not really going to analyze this, but just want to state, we got Louisiana, North Carolina, Indiana, New Hampshire, Florida are the top 5, and we can figure out, probably what the industries are in those states anyway. So that's a scoop on that. This is what caught my eye, and this is where I'm going to sort of start off on the housing issues right here, is as of April 1st, there was $81 billion in rent estimated that was due April 1st. So whether you're a landlord looking to collect rent, whether you have a multi-family apartment complex, whether you're a commercial client and you own a store, or you've leased a space in some commercial development, roughly $81 billion was due on the 1st of April. How they calculated this, I don't know. But basically, the hardest thing right now is that no one really knows how bad that's going to get. I mean, this is just the expectation. Like, out of that 81 billion, how many people are not able to pay their rent? We know that there are certain businesses out there, certain restaurant chains or businesses that have basically said, we're not paying. So we've basically given notice to our landlords that we're not going to have the capacity to pay, or just not going to pay. Now, on the commercial side, that's not, you don't really, it's not a personal foreclosure they would face in the future. So there's ways. I mean, it'll be litigation. They can tie some stuff up in court. They can use their lawyers. But again, if you work for a restaurant chain, for example, the one that I spoke of, I think last week, was the Cheesecake Factory. The Cheesecake Factory was, I guess you could say, was reportedly, going out, right out front saying, we're not paying. Simple as that. And the reasons being, well, because we can't serve customers. We have employees that we have to pay, and we don't have the income coming in to justify any of that. I mean, I'm just paraphrasing here, but ultimately they're looking at going, we just can't do it. And if that's the self-preservation method for that corporation, they got to do what they got to do. So that's an example of the higher end issues, all the way down to people who live in mobile homes. And I have a lot of friends, a lot of contacts, and part of the issue that we'll see going forward is the misinformation, the lack of information, or the assumption based on reading media headlines. I've had people who have rental property, and their clients have already said, I don't have to pay you rent, right? The president said I don't have to. So, people are taking that stand going, screw you, basically. And which is kind of sad. Now, I look at it going, that's your own personal decision. If you can afford to pay rent or pay your mortgage, then that's your obligation. If you can't, then obviously you have to figure out what you're going to do, and you'll have to deal with the consequences that may surface or arise out of that afterwards. So, as we've talked about sort of briefly in other videos, forbearance is obviously being looked at. The issue will be what's going to happen with payments and how that's going to play out after the fact. Evictions are stopped as of now, but how long is that going to go? So obviously, the local governments don't want people put out in the street looking for places or displaced while we are in sort of a lockdown effect and we don't have essential businesses going on. So it's really difficult for people right now. And I think this really is going to be unprecedented and will be way bigger than we think it's going to be, and the analysts and economists think it's going to be, and this will have bigger than the last housing bubble. Personally, that's what I think. And stop, like, how can I put it? We just can't figure it out now. Like, how this will trickle down, how this will impact down the road, the lenders, etc. I think right now they don't know the wave that's going to come after them. So here's a thought: maybe they'll be hiring, right? If you want to work for one of the lenders processing these forbearance claims, whatever, there's going to be a lot of work going on behind the scenes to figure all this stuff out. But 81 billion in rent is a big number, and I'm assuming that number is only going to get worse with respect to what's owed, and who knows what's going to pay or who can pay as time goes on. So we're moving now into the economy section here, and COVID-19 will cause a record-setting recession, economists say. So economic forecasters are saying the recession caused by COVID-19 pandemic is going to be record-setting, followed by a rebound in the final 3 months of 2020 that should result in the largest quarterly expansion in almost 6 years. So the prediction is for the next 6 months it's going to be chaos, and then once we're out of the 6 months, we're going to see everything shoot back up because of the volume, everybody catching up, etc. Well, I don't know about that because, more than half of all Americans are in states with governors who ordered residents to stay at home, with the exception of essential workers, and so that's going to affect people's income more than I think than we can even calculate right now. GDP will probably contract 15% in the second quarter, according to an estimate by Wells Fargo economists on Friday. That would be the biggest plunge ever recorded in more than 70 years. The third quarter will probably see a 6.3% contraction, meeting the classic definition of a recession, 2 consecutive quarters of GDP decline. So, excuse me, again, pollen, been outside a lot. That's the scoop right now. So we're going to see they expect 2 consecutive GDP declines, which is a recession definition exactly. And the issue is that we've gone from full throttle to a sudden stop. That's how the Wells Fargo economists explained it. The economic carnage produced by that abrupt shutdown of economic activity across the country is readily apparent from the weekly unemployment claims, which we now know is up to over 10 million. Now, when this article was written, we just knew that the initial claims were from the first week of 3.28 million. So they don't, this is before that 6 something million came out last week. So again, realize that I think we're going to see adjustments going on. It's almost like we can't figure out how this is going to balloon, and every economist will be adjusting their thoughts from the previous week. So again, I just had to catch up, I guess, with respect to, I guess you could say, news here, but it's going to get worse before it gets better. Now, Black Knight Financial, which serves the mortgage industry and the real estate industry, basically had a white paper talking about the housing impact and stating these are unprecedented times for the world on the whole and for the real estate and mortgage industries. Despite the current state of the market, the Black Knight said the mortgage market was on solid ground and record-setting to begin 2020. We saw a lot of refis, a lot of surge in refinances for property and things like that. However, by the third week of March, COVID-19's impact was felt nationwide. 38 states currently under the stay-at-home orders. And of course, since March 26, more than 10 million Americans have filed unemployment claims. So it rose, so big time. So really, it's, we had a lot of cash out refis. We saw purchase applications slowing down. I mean, still moving, but not on the refi basis. So people already were turning away from the marketplace. The potential impacts on the real estate and mortgage ecosystem are significant. General uncertainty in the market and among the public could impact not only the willingness of prospective homeowners to transact, but also that of lenders to lend and retain business. So now we're going to be in a situation where, okay, we need homes to sell to move the economy along. Well, you know what? Maybe we're not, you're not going out. I'm not going out to look at properties. Well, I still look at properties, but I look at vacant ones, and I'm there by myself, basically. So, but, if you wanted to go to an open house, well, you're not probably going to do that. And furthermore, a lot of home sellers that want to sell their homes now aren't having open houses because they don't want people walking through their homes, touching everything and spreading viruses and germs. So we're going to see just I think a contraction in sales activity. We've already started to see that, and that's going to slow things down. So if you are seeing a contraction in sales activity, what do you do as a seller to attract a buyer? You decrease your price point. So, or you offer incentives. So either way, we're going to see a reduction just from the fact of pure sales volume will necessitate a reduction in price point. So we're going to start seeing that now and go from there. Now, this impact will be the result of several factors, including few buyers physically out in the market, as well as fears of recession and economic uncertainty among potential buyers. So yes, when we're in a situation like this, I think the furthest thing on people's mind is, hey, I got to go look for a new house, right? It's more like, how am I going to feed my family? How am I going to, buy things that are unavailable at the store, kids, schooling, all these type of things, elderly, relatives, like so much to worry about and think about. Housing's just not on the forefront right now. So we're going to see that effect going forward. And, the results are they're looking at maybe a possible 30% decline in purchase lending going forward, which obviously would be a larger result in purchasing going on in the future. If they're predicting a decline in lending, obviously it'll be a little more on the purchasing side. Having said that, available inventory slumps by 15.7% in March. So basically, the Realtor.com reveals that the national inventory fell almost 16% annually in March, which is faster than the 15.3% year-over-year drop reported in February. So we basically have a situation now where 2 consecutive months we've seen double-digit declines in inventory, which can do which to me says a couple of things here. People don't want to put their homes for sale. It's the wrong time. I agree with that. And also people are pulling stuff off the market because they don't want to engage sellers, or they figure, why should they bother? Again, if you again, economic uncertain time, so you pull things off the market. Also, if you sell your home and you close, where are you going to go? So then you got to go find a place to buy a home or rent someplace. So again, it's that whole transition thing. You're going to be out in the public, out engaging, and I think people don't want to do that at this point in time. So a lot of unknowns going forward. Basically, the decline in inventory could be softening, but everyone's talking this is going to hurt the industry so badly because as we enter April now, we're entering the home spring selling, buying, selling season, which typically is sort of the best time of the year, or the time where we see the most sales activity going on in the marketplace. So basically, we're not going to see that. Housing inventory in the 50 largest U.S. metros across the country declined by 17.1% year over year. So that's pretty significant. And what you're going to see, though, is listing price growing. So they said also listing price grew by 3.8% in March to 320,000. So there's still a growth in listing price with respect to lack of inventory. We're still going to see locations that are still going to squeak out smaller increases because there's just less property to choose from. So those that have to buy will buy, probably pay a bit more for it right now. Again, it's too early to see the impacts of all the job losses and the mortgage defaults, etc. We're not even a month into it, maybe just a month right now. So we're going to see how this all plays out. Clearly, April 1st was the date where rent's due and mortgage payments are due, etc. And so we will now start to see a handle as to, like, next month. We'll obviously report on April, and we'll find out, how many, we'll just get better numbers. Put it that way. We'll find out 30-day delinquencies, things like that. We'll start to see more information as to how this is actually going to play out. So again, difficult time. I guess to summarize, I know I'm talking in circles here, a lot of unknowns, right? We have lots of premises we can work on. We have a lot of, I guess you could say, ideas and thoughts as to where this is going to go. But right now, because we're so early in this situation, there's just a lot of unknowns. A lot of people are saying it's going to blow over, not going to be a big issue, things will change for the better. Yeah, that may very well be, but I really think that the impact on housing is going to be worse than 2008. Remember 2008, what was some of the issues? We had speculators, we had subprime borrowers, we had a ton of cash out refis that created the chaos, a lot of inventory, and that was more. So that I guess was more fluid. Now we have people just losing their jobs. So a lot of that stuff was just I made poor decisions back in the day and got greedy and overbought or overextended myself. Now we have people who aren't speculators. They rent or they buy a place because that's their life, and now they can't pay. That's a whole other issue, and that's why I think that's going to be a lot more. Like if the last housing crisis, roughly 10 million people lost their homes to foreclosure during that time frame. If we have roughly 10 million people now who are out of work, and it's only going to get larger and larger, that's why I think that the volume can be much bigger, comparatively speaking. Now, what typically happens when you have a situation like this? So after the last housing crisis, what did we have? We had lots of short sales with tons of foreclosures. Every lender tightened. We had, of course, lenders who went under, got absorbed by bigger lenders. We had TARP, we had all the bailouts, etc. But if you were still looking to buy a home as an individual home buyer, just primary home buyer, you were qualified for a mortgage, you faced a lot of scrutiny in mortgage lending standards. All right, so that's what's going to happen in the future. So when we have issues, there's a big contraction, and then everything gets tightened up, and then the process to move the economy and move the housing market kind of stalls because everyone's too scared to lend, and everyone changes their standards. So basically, right now it says Fannie Mae, Freddie Mac tightened some lending standards, loosened others amid the coronavirus crisis. So basically, what they're doing now is they're more concerned about people who have, they're self-employed or their own businesses, etc., applying for homes. So again, not everybody fits into the W-2, I'm an employee box, and that's the problem. So people who need to buy a house are going to have a hard time because they're going to be they're going to have to jump through more and more hoops to get approved for mortgages. So basically, according to both the GSEs, Fannie and Freddie, they are changing the age of document requirements for most income and asset documentation from 4 months to 2 months. So when you apply for a mortgage and you go through the stipulations, they want to see tax returns, employment, all these type of things. Well, they look, they're okay taking documentation over a period of time. What they're doing is they're now going to shorten that time frame because they realize that, hey, if you're giving me documentation from 4 months ago, which looks good, doesn't reflect on what's happening right now in our economy, which could not be as good and might make a decision different and give you that mortgage. So that's what we're going to see. So people who maybe were pre-approved before aren't going to be, might get those approvals or those loan commitments denied because of the changes in their most recent business or their income. So that window was 120 days. It's now going down to 60 days. And again, Fannie Mae's announcement states that the change is being made in order to ensure that the most up-to-date information is being considered to support the borrower's ability to repay. So as the lenders are looking at unprecedented non-payments starting this month in April, they don't want to compound that by offering mortgages to people who within a couple months may not be able to pay as well too. So so unfortunately, people who are in that boat, you're going to be penalized just for the situation, the timing that we're in. So it's all about income verification. And basically, according to the GSEs, lenders will need to verify a borrower's. So if say you have your own business, you're self-employed, we need to verify a borrower's business is still open using the methods below. Evidence of current work, which is contracts or signed invoices indicate the business is operating on the date the seller verifies self-employment. Evidence of current business receipts within 10 business days of the note date. Seller certification the business is open and operating. The seller confirm that via phone call or other means. Business website demonstrating activity supporting current business operations. So they're basically looking at going, we're going to scrutinize these loans we're going to release to people, a lot more. So that's your situation. So, and then what they'll probably end up doing here, they may increase your down payment. They may have higher, lower loan to value loans now. So before maybe, you qualified for, not 5% down loan. Now it might be 10% or 15 or 20%. So we're going to see risk mitigation going on for consumers, and the consumers are going to pay the price for that. So that's just the way it goes. So just something to think about here. The world is changing. Housing is changing. For me, it's more of let's see how April 1st came about now. So so in summary, what have we seen so far? We've basically seen the government and lenders and like FHA or HUD, Housing and Urban Development, state that we're going to push off. If you have a foreclosure sale date, we're not going to put you out in the street. So we're going to postpone the sale date. At least for 60 days. They're going to revisit that after 60 days. So there could be an extension there. After whatever date expires, realize that they're going to reset the sale date pretty quick afterwards. So people who are in that situation, you got a bit of time, but realize that once the numbers, that the 60 days, if it's not extended or whatever the date is, when that's over, they're going to reset the dates pretty quick after. So please keep that in mind. For that situation, buy yourself some more time and start inquiring about a short sale. And that way you can even buy yourself more time with the situation. Evictions. So if you're in a situation where there's an eviction, so realize that evictions are still being processed, because I know that right now, because I know people who are processing their evictions. What isn't going on is literally the sheriff knocking on your door saying, in 48 hours, you're going to be on the street, get out now. So the eviction process can still take place, albeit the court system has to still work through that, and therefore you need to find out, or you need to keep on track of whatever you're doing from the eviction side. But so you might get the judgment in your favor, but the actual physical eviction process won't be done until that ban's been lifted. So we've got that going on here. The forbearance. So we'll see how that plays out right now. We don't know. It's too early. Every day I read about more and more discussion points from FHA, from lenders, as to how they're going to handle things, and some of it still is kind of ambiguous. So my last video was really talking about forbearance, and please realize this, and I guess this is a disclaimer I have to say here, is that you got to check out your own personal stuff, okay? Just because I said it here doesn't mean that's written in stone. I'm basically repeating or regurgitating what I'm reading in these articles, which I do post in the information section about the video, so you can go look at them yourself. The best thing to do is go to the lender's website that you have, your lender's or servicer's website, find out what they're offering, contact them directly, and find out what options are available to you and figure stuff out. So again, my concern though is that this is going to be way bigger than they anticipate. Can they handle the volume? I don't know. And can all these, we'll call it, ways to repay it spread out over time, whatever, will that actually work? I don't know, because a lot of it didn't work in the last housing crisis. So what's changed? I don't know. We'll see if they couldn't do it then, why can they do it now? And we'll see from there. Please realize that I think there's are bigger things going on behind the scenes in housing right now, which benefits certain segments of the marketplace, which is for a future video. I know I'm being cryptic here, but I think I really believe I know how this is going to play out, and it's not always pretty for or beneficial for the homeowner or want to be homeowner in the future. So just as I mentioned, this will be an evolving and transitioning sort of information play here, because we still don't know how it's all going to play out. They're still figuring out. It's still early on, and as I mentioned, I just don't think that anyone is going to be prepared for the volume that they're going to face. One of the things that hurt people in the last housing crisis was just that. That was the volume. And the court systems couldn't handle the foreclosure filings. Lenders couldn't handle the people who were looking for support. Governments issued mandates to help, got to help your people with loan modifications and things like that. And they just, couldn't do it, or couldn't or wouldn't, didn't have the capacity, didn't have the know-how, the knowledge. Lots of people didn't get service and subsequently lost their homes because they had done what they needed to do, but it couldn't go through the lender's process in time and the backlog, etc. So I know that they're more prepared, because I know that they've been preparing for the housing bubble over the past year. So they've beefed up this is the loss mitigation area, mortgage, the mortgage mods, the short sales, the foreclosures, that all falls into the loss mitigation area of sort of the lender's operation, the servicing company's operation. But again, I don't think anyone was anticipating what's going to happen with the volume of people that will hit this on a going forward basis. So that's it for today. I'll start putting out a few more quicker videos with more dedicated subjects on what I think is going to happen. I'm not hedging my bets. I just want to make sure that I've got the right information to talk about here on the videos. Do your due diligence. Make sure you're not being hurt by the process. Make sure you understand the process you engage in. That's my biggest takeaway for anybody here. And read. Like, in other words, read the articles. Don't just read the headlines, because headlines sound great. When you start reading as to what they're going to do or not going to do, then you understand a bit more. I've already seen evidence of people who are getting stuff from their lenders that I think is not clear and might lead people to the wrong conclusion, and they'll be hurt later on down the road. So keep that in mind. All right, having said that, if you'd like more information on what's going on in the world today, so I've got my turnkey investment process going on here. Got a lot of access to good opportunities. You might say, well, why would you want to buy now? Because prices will drop. Well, here's the thing. Talking cash flow properties. So sometimes cash flow properties are, you obviously don't want to overpay for them, but we're getting them at some good deals right now, and they can cash flow, and that's a good opportunity. Sometimes cash flow properties, if they're cash flowing correctly, sometimes are recession proof, which is very nice, because people still need to live and they need to pay rent, and there'll be a lot of stuff happening in the very future. I anticipate more people will be becoming renters as time goes on. That's a great opportunity there. Also, the short sale world. If you want to learn more about the short sale world, which I have advanced training for that, please drop me a line, contact me via email, give me your phone number. We'll make sure we hook up and discuss. And that's it for now. So look forward to talking to you guys in a couple of days. Thanks.